Hello, it's Joshua here with another edition of Mortgage Clarity. And in today's episode, we're going to talk about kind of FHA basics. FHA is a popular program, and we're just going to do some high-level hits on this. We're not going to cover it all in this video. If you have additional questions on this program, feel free to comment below or reach out to me more directly. So FHA is a program where a lot of people think of it as a first-time homebuyer program, but that's not the case. If you've owned multiple homes, you can still use an FHA loan as a source. Now, FHA has been considered a kind of a first-time homebuyer program because typically with first-time homebuyers, the amount of money they have for down payments is more limited than those who are selling a home and then buying another home. And so FHA's minimum required down payment is 3.5%. Now, if you go back in time, conventional loan programs were requiring typically 5% or more for a down payment. So that's why FHA was a little bit more favorable. However, Fannie Mae and Freddie Mac, the two conventional programs, they both have 3% down options for borrowers that are first-time homebuyers. And so if you look at that, that's no longer really a primary reason for that. Although, if you're not a first-time homebuyer, on the conventional programs, you do have to be a first-time, one of the borrowers at least has to be a first-time homebuyer to be able to do the 3% down. With FHA, that's not a requirement. So if you're not a first-time homebuyer and you want to do low down payment, FHA would then be the way to go. Now, definition of first-time homebuyer, in the lending world, that means you have not owned a property in the last 3 years. So even if you've owned lots of properties, but for the last 3 years, you have not been entitled to any real estate, then you're considered a first-time homebuyer again. Now, some other things with FHA that makes it more favorable is for borrowers with lower credit scores and challenged credit, FHA can be a better alternative. So let's go over that really quickly. So with conventional, while it will allow lower credit scores and still qualify, it doesn't go as low as FHA. Conventional technically will go down to like a 620 credit score, but you'll start to find that you have a very difficult time getting the system to approve it, or has much more restrictive debt to income ratios with those lower credit scores. And also the impact to the cost of the rate and the mortgage insurance starts to make it not as favorable. With FHA, you can actually go down to 580 or have no credit score. We won't talk much about that in this video. And the program's still available, and it doesn't have a hit to the cost of the mortgage insurance. With FHA, as long as you qualify, your mortgage insurance is going to be the same, regardless if you have a 580 credit score or a 760 credit score. Now, there can be some changes in the interest rate with those lower credit scores on FHA, like with conventional, but the impact to the rate and at what point that impact starts to play in is much more flexible than with conventional. So example, with a 660 credit score, you're going to see a less of an impact to the cost of the rate than you would see on a conventional loan with a 660 credit score. Now, some other benefits of FHA compared to conventional is it's a little bit more liberal, or can be more liberal when it comes to things like debt to income ratio. And this is one of the key factors in deciding what your max purchase price would be, is when we look at the house payment for the proposed purchase plus your other consumer debt, what does that represent as a percentage of your income? Now, this is kind of a moving target depending on lots of different things for different programs and your credit scores and down payments and such. But as a general rule, we would say that on a conventional loan, they like to see that max debt ratio around 45%, though the right situations, I have seen it go to 49. Whereas with FHA, it's pretty flexible and quite often goes to 55%. Now, again, it doesn't mean guarantee that yours will. There's more that goes into it, but the program is much easier to go higher on that. So that's one of the benefits for FHA compared to conventional. Now, another big reason why somebody might go with FHA, even if they had a larger down payment and could put maybe even 20% down, is when it comes to things like significant derogatory items on your credit report. So these would be things like, have you ever had a foreclosure, a short sale, a bankruptcy, a Chapter 7 or Chapter 13, or do you have judgments on your credit report? So with those types of things, each of the different programs, whether it's conventional, FHA, USDA, and VA, have different mandatory waiting periods. And this is, again, where it really makes a big difference comparing conventional to FHA. So for example, if you've had a foreclosure on your record, conventional requires a minimum of 7 years from the date in which the property title transferred out of the persons who had the foreclosure into the bank. So from the date that recording happened, there's a minimum 7-year waiting period. Whereas with FHA, that wait period is like 3 years. So a substantial difference there. And again, these will vary with other programs as well, but with FHA, it's a 3-year versus 7 years. When it comes to something like a bankruptcy, like a Chapter 7, on a conventional loan, typically it's a 4-year waiting period. With FHA, it's 2 years. Now, there are certain exceptions that can allow for shorter time if there's extenuating circumstances that led to the bankruptcy, but those are a few exceptions, and so that's the general rule. Now, the other thing we would talk about with FHA and why it may not be the best option is both conventional and FHA have max loan limits, which means that after you put your down payment down, that loan can't exceed whatever that max limit is. And that can vary from area to area, so I won't go over what those numbers are. But conventional has a higher max loan limit than FHA does. And so possibly if you're a borrower and you have a lower credit score, when you crunch the numbers, FHA would offer a lower monthly payment for the loan amount you're seeking. If that loan amount exceeds that limit, you might be forced to go into a conventional loan, even though it may not offer the best payment compared to the two. So those are a few different things. Again, really quick on FHA. It's a great program. It doesn't matter if you're a first-time home buyer or not. It's about looking at the overall situation, what you've got, and then from that point, determining which program benefits you as the consumer the best. So I hope you found this helpful. If you have any questions, you want to know more information, please feel free to reach out. If you like this video and think it's helpful, please hit the like button. That helps bring it attention to other people that might be able to benefit from this information as well. And if you haven't already, subscribe. All right, have a great day.